I'd like to ask a question on financial reform that's been wending its way through Congress. A lot of the attention has been focused on the big financial institutions and the banks and how they should be regulated and whether they, should be caused to be smaller or to be broken apart. But I'd like to ask you specifically instead on investor protections. And there had been some talk about the fiduciary standard and who it should it apply to. But from what you've seen in the reform measures, what do you think is the most important protections that should come out for investors, and what do you think are the odds that we'll see something that will actually be able to help the individual investor steer clear of danger out there?
Well, very little of this reform that we're seeing is shaped around the interests and needs of individual investors. It's shaped around big financial institutions by and large, and by trading mechanisms, derivatives and things like that, and speculation. The problem is we've gotten into, for at least far too large a portion of the market, into an era of where the folly of short-term speculation has overwhelmed the wisdom of long-term investing. And the mathematics guarantee us, that if you're an investor, you will do better than a speculator, because a speculator carries all those trading costs, and a long-term investor doesn't. There's no way around those mathematics. So the Consumer Protection Bureau, apparently going to be part of the Federal Reserve. I don't particularly like that, but maybe they can make them reasonably independent. Barely touches the need for consumer protection in the mutual fund industry. And I think there is a lot of need for consumer protection. I don't know exactly how to put it, but I think too many funds have been too opportunistic. Too many funds have been too focused on salesmanship instead of stewardship, on speculation and not on investment. On high cost, which totally destroys, any kind of margin in that those markets I described for the future. Just think about, say, a 7% return on stocks and a 4.5% return on bonds. Let's call it a 6% return in a balanced portfolio. But that's before the mutual funds take their cut of maybe 2.5% a year. So we need better disclosure of all those all-in costs, expense ratios, estimated trading costs, and impact of sales loads. So we can get a total cost that will give you some idea of what you might net at the end of the period. And we also this will be painful for everybody, start to talk about real returns in the future rather than nominal, because that's, say, 6% return in a balanced portfolio. Let's say 2% at least for the cost of investing leaves 4% in nominal return. But if we have a 3% increase in the consumer price index, that will leave 1% for the investor. And if he pays 1% to an investment advisor, which is a reasonable number, that leaves the investor with, 1% after cost return, forgetting taxes even, and 1% advisory fee, and the investor is going to have a zero return. So he ought to be cautious. We all ought to be cautious about controlling the things we control, the time we're in the market, the time horizon of the managers we apply, the risks we assume, the costs we undertake. And while we can't predict returns with any accuracy, we ought to be thinking about controlling what we can control, and that will be the secret to including asset allocation, and that will be the secret to success in the coming decade.
Your answer sort of leads me to just one final point I'd like your thoughts on. To what extent, then, do you think that well-crafted regulation, how far can it go, and how much do investors really need to help themselves to make the best decisions? And, regulation maybe can go some distance, but at the end of the day, it's the investors that really are going to have to be their best guardians, would you say?
Let me say that as I look at it, and I've written a little bit about this, there are two solutions to the mess we've created for individual investors today. One is the one you just described, which I call the Adam Smith solution, that each investor looking after his own best interest will figure out how to deal with those issues I just touched on: asset allocation, cost, taxes, inflation, all those things, deal with them rationally, and seek out the mutual funds that offer the highest opportunity for achieving his goals. And those are going to be, by and large, low-cost funds. I have to say that the mathematics prove it. The best opportunity is index funds for their tax efficiency and low cost and low turnover, and usually no loads. But that's an opinion point of view that's based on math, but still my opinion. So that problem with that solution, it's going to take years, if not decades. In other words, each year, each month, each day, 1 or 2 more, or 1,000 more, or 1 million more investors will gradually learn the foolishness of this investment system we have and do the right thing for themselves. And that will solve the problems, because firms that don't provide investors with a way to meet their needs are going to gradually dry up and disappear. The other solution, which I happen to like better because it's immediate, time is money in this business. Each year under the existing system is expensive to investors. So I prefer a quicker solution, which I would call a federal statute of fiduciary duty for all institutional money managers, including mutual fund managers. And that would require them to put the interests of their shareholders first. It would eliminate conglomerate ownership of this industry, owned in a very important way by financial conglomerates, who are here to earn a return on their money and not a return on your money, the money of the shareholder. And to try as they may, they can't do that if they're in a marketing business and in which their revenues and profits depend on raising costs or keeping costs high. And so if we can get that, it would also make funds more into long-term investors and take the speculative costs out of the equation. And it would also force these fiduciaries, now call them mutual fund and pension fund managers, to put pressure on the corporations they own, the corporations that are in their portfolios, to run themselves in a way that favors shareholders. Because in corporate America, you have a big problem with a lack of fiduciary duty, in which corporate CEOs put their own interests and the interests of their associates before the interest of shareholders. So if money managers would demand a fair shake, that would go a long way, and I know of no better way to do that than the federal statute of fiduciary duty.
Mr. Bogle, as always, it's great to hear your insights. Thanks so much for calling in today.
Good to talk to you.
From Morningstar, I'm Jason Stipp. Thanks for watching.